There's a guy who's been investing for 11 years. Every month, without fail, he moves money into his brokerage account. He reads the financial news. He rebalances quarterly. He understands dollar cost averaging, expense ratios, asset allocation. He does everything the books tell you to do. And last year at 44, he did an honest accounting of where he actually stood versus where the math said he should be after 11 years of disciplined investing. The gap was $340,000. Not because markets underperformed, not because he picked bad funds, because of 4 specific decisions he made that felt smart at the time, that every credible source validated, and that were silently bleeding his returns in ways he never calculated until he finally sat down and ran the real numbers. The most dangerous financial advice isn't obviously bad advice. Obviously, bad advice is easy to dismiss. The most dangerous advice is advice that is technically correct, socially validated, delivered by credible sources, and subtly wrong in ways that compound quietly for decades before you see the damage. It's the advice that gets nodded along to in every personal finance article, repeated by every financial planner, and followed obediently by millions of people who are doing everything right and somehow still ending up significantly behind where the math should have put them. I'm going to walk you through the 5 specific pieces of widely accepted, institutionally endorsed investing advice that are hurting more people than they're helping. Not because the advice is malicious, because it was designed for a different environment or for a different kind of investor, or with assumptions so buried in the fine print that nobody reads them, and because the financial industry benefits from you following this advice in ways that have nothing to do with whether it benefits you. Let me start with the one that will make the most people uncomfortable because it's the most universally celebrated piece of investing advice in existence. Set it and forget it. Automate your contributions, buy index funds, never look at it, let it grow. You've heard this 1,000 times. And the core of it is genuinely correct. Automated contributions are better than discretionary contributions. Low-cost index funds beat most active management over long periods. Panic selling is destructive, and not watching every tick of the market prevents panic selling. All true. Here's what's wrong with it. Set it and forget it was designed as an antidote to overtrading and market timing, 2 genuinely destructive behaviors that hurt retail investors consistently. It was not designed as a complete investing philosophy, and somewhere along the way it became one. It became permission to disengage entirely, to never review whether your allocation still makes sense, to never assess whether the specific funds you're in still serve your goals, to treat your portfolio like a crock pot where you put the ingredients in once and come back 30 years later expecting a perfect meal regardless of what happened in between. The set it and forget it philosophy has a hidden assumption baked into it that almost nobody states explicitly. It assumes your situation doesn't change meaningfully over 3 decades. Your income, your risk tolerance, your time horizon, your goals, your tax situation, your liabilities, your family structure, and that your portfolio's internal drift, as some assets grow much faster than others, doesn't need periodic correction. Both assumptions are wrong for almost every person alive. Your situation changes constantly, and a portfolio that starts at your intended allocation will drift significantly over 5 to 10 years as different assets grow at different rates, which means the risk profile you thought you had is not the risk profile you actually have. The person who set it and forgot it in 2015 with a 70/30 stock bond allocation discovered in 2023 that they were at 87/13 because equities had grown so much relative to bonds. Totally different risk exposure. Never reviewed, never corrected, until the next crash makes them suddenly very interested in what they actually own. Set it and forget it is excellent advice for contributions. It is incomplete advice for portfolio management. The correct version is automate contributions, review allocation annually, rebalance when drift exceeds a threshold, and reassess overall strategy when your life changes significantly. That version requires 15 hours a year and produces meaningfully better risk-adjusted outcomes, but it doesn't fit on a motivational poster. The second piece of advice that sounds smart and works against most people is diversification across lots of funds. You've been told diversification is the only free lunch in investing, which is true. Proper diversification genuinely reduces risk without proportionally reducing return. But there's a version of diversification that people implement that has the opposite effect. I call it false diversification through fund multiplication. Here's how it happens. You read that diversification is good. You have a 401k with 15 fund options. You think more diversification means more funds, so you split your contributions across 8 of them. You have a large cap fund, a small cap fund, a mid cap fund, an international fund, a bond fund, a REIT fund, a sector fund, and a target date fund. You feel very diversified. Here's the problem. When you look at the actual holdings inside these funds, you discover that your large cap fund and your mid cap fund and your target date fund all hold Apple, Microsoft, Amazon, and Google as top positions. You own them 3 times over. Your international fund has significant US multinational exposure. Your REIT fund correlates heavily with your large cap fund during market stress, which is exactly when you need them not to correlate. You think you own 8 different things. You own 3 things with a lot of overlap wrapped in 8 different fund labels. Real diversification is about correlation, not quantity. 2 assets are truly diversifying when they move independently, ideally in opposite directions under stress. Owning 12 stock funds doesn't diversify you. It concentrates you in equities with different labels. Real diversification means assets that genuinely behave differently when markets get ugly. US stocks, international developed markets, emerging markets, real assets like commodities and infrastructure, short-term bonds, cash. These move with enough independence that combining combining them actually smooths the ride. 12 variations of US equity exposure do not. The expense ratio story is the third piece of advice that's technically correct and practically incomplete in ways that cost people real money. You've been told to minimize expense ratios, which is right. The difference between a 1.2% expense ratio fund and a 0.04% expense ratio fund compounded over 30 years is genuinely enormous. On a $500,000 portfolio, the difference in fees alone over 30 years is something in the range of $300,000 to $400,000 depending on return assumptions. Minimizing fees matters. Nobody serious disputes this. Here's what the expense ratio obsession misses. Transaction costs, tax drag, and behavioral costs are often larger than the expense ratio difference people agonize over. Someone who switches funds trying to find the fund with a 0.02% expense ratio instead of 0.05% is saving $150 a year on a $500,000 portfolio. If that switch triggers a taxable capital gains event, they may have just paid $8,000 in taxes to save $150 a year, a 50-year payback period on the optimization. Someone who holds an intelligently constructed portfolio in slightly higher cost funds inside a Roth IRA pays no taxes on growth or withdrawal. Someone who holds slightly cheaper funds in a taxable account pays taxes on dividends annually and capital gains on every rebalance. The account location question dwarfs the expense ratio question. But expense ratios are easy to compare on a chart, and account location optimization requires actual thinking. So the industry focuses your attention on the former. Behavioral costs are bigger still. A portfolio you understand and feel comfortable with that you actually hold through downturns beats a theoretically optimal portfolio that you panic sell when it drops 25%. The emotional resilience to stay invested is worth more than almost any fee optimization you will ever find. And yet nobody in the financial media is writing headlines about behavioral cost management because there's nothing to sell attached to it. The fourth piece of advice that quietly damages people is target date funds as a complete retirement solution. If you have a 401k and you've never thought carefully about what you're invested in, there's a good chance you're in a target date fund. They're the default option in most 401k plans. They're simple, they're automatically rebalancing, and they're marketed as the hands-off retirement solution. Pick your retirement year, buy the fund, done. Here's what most people don't know about target date funds. First, there is no standardization. A 2040 target date fund from Vanguard, and a 2040 target date fund from Fidelity, and a 2040 target date fund from a smaller provider can have dramatically different allocations and underlying holdings. The year in the name is not a regulated specification. It's a marketing label. Two people both holding 2040 funds can have significantly different risk exposures without knowing it. Second, target date funds get more conservative over time, which sounds right and is not always right for you specifically. The conventional wisdom is that you should shift from stocks to bonds as you approach retirement to protect against sequence of returns risk. But the appropriate allocation depends on your specific situation. Your other assets, your social security income, whether you have a pension, your spending flexibility, your health, your risk tolerance. A person with a generous pension and social security that covers all their fixed costs can afford much more equity exposure in retirement than a person who is entirely dependent on the portfolio. The target date fund doesn't know any of that. It runs a generic glide path that is optimized for an average person, which means it's probably suboptimal for you specifically. Third, target date funds often hold the fund company's own underlying funds, which means you're exposed to that company's specific choices about what goes inside them. And because the whole point is that you're not looking, those choices can drift in directions that don't serve you without you noticing. None of this means target date funds are terrible. For people who genuinely won't engage with their portfolio at any level, a target date fund is dramatically better than leaving money in a money market default or making no contributions at all. But positioning them as a complete retirement solution for every person regardless of circumstance is misleading. They're a starting point, not a destination. The fifth piece of advice, and the one that I think has done the most subtle damage to the most people over the longest period of time, is the idea that you should always maximize your 401k contributions before investing anywhere else. This is presented as obvious, as foundational, as the first rule of personal finance. And the logic sounds airtight. Pre-tax contributions reduce your taxable income today. Tax-deferred growth compounds without annual tax drag. Employer match is a guaranteed 50 to 100% immediate return on your contribution. All correct. Here's what the always maximize your 401k advice ignores. Your 401k is a specific legal structure with specific rules attached to it. You cannot access that money without penalty before 59.5 except through very specific and limited mechanisms. The investment options available inside most 401k plans are limited to what your employer chose to offer, which is often a narrow selection that may not include the best available options in each asset class. And the tax benefit is real, but the direction of the benefit depends entirely on whether your tax rate is higher today when you contribute or higher in retirement when you withdraw. For someone early in their career, making relatively modest income, who expects to earn significantly more over their lifetime, traditional pre-tax 401k contributions may actually be the wrong choice. Their tax rate today is low. Their tax rate in peak earning years and potentially in retirement if they've been disciplined and have significant savings may be higher. Contributing pre-tax today and paying more taxes on withdrawal in the future is not necessarily necessarily a win. A Roth 401k or Roth IRA, pay taxes now, withdraw tax-free later, may be the better structure for their specific situation. The always maximize the 401k advice also completely ignores the liquidity trade-off. If you're 28 and you put every available dollar into a 401k, you have no accessible investment assets outside of your emergency fund. When you're 35 and want to buy a house or start a business or take advantage of a significant opportunity that requires capital, that money is locked away behind penalties and tax consequences. Some allocation to a taxable brokerage account where your money is accessible without penalty whenever you need it is a meaningful consideration that the maximize the 401k first doctrine papers over entirely. The correct framework is not maximize the 401k always. It's get the full employer match always. That's free money and the return is genuinely guaranteed. Then consider whether pre-tax traditional or Roth is right for your specific tax situation. Then evaluate how much liquidity you actually need in accessible accounts over your foreseeable horizon. Then optimize 401k contributions within that framework. That's a more complex answer than maximize the 401k first, which is why nobody says it. But it's the honest answer for most people under 40. Let me tell you about someone who implemented all 5 pieces of this bad advice correctly and where it left him. He's 46, invested for 15 years. His portfolio is in 8 funds inside his 401k that he set up at 31 and reviewed twice in 15 years. He maximized his 401k contributions every year. He has no taxable brokerage account and no accessible investment assets outside his emergency fund. His funds have low expense ratios. His target date allocation has gotten conservative ahead of schedule for his specific situation because he has a side business and rental income that the fund doesn't know about, and that changes the optimal equity allocation significantly. His funds have significant overlap, and he's actually running about 70% of his portfolio in variations of US large cap equity without knowing it. He's followed the rules diligently, and his portfolio is performing fine on paper, but it's structured in ways that will cost him real money in taxes in retirement that don't reflect his actual risk capacity and that leave him no accessible capital for the business expansion he's been considering for 2 years. He didn't make bad decisions. He made decisions that were validated by every credible source he consulted. The problem is the advice he was given was generic and he applied it generically. And generic advice applied to a specific situation produces specific suboptimal outcomes that compound quietly for 15 years before they're visible. Here's what good investing advice actually looks like. It starts with your specific situation and works outward, not the other way around. What is your tax situation today and what do you expect it to be in retirement? That determines the traditional versus Roth question. What is your actual risk capacity? Meaning, how much volatility can you genuinely withstand without making panic-driven decisions? Not how much volatility should you theoretically be able to handle. That determines your equity allocation. What are your liquidity needs over the next 5 to 10 years? Meaning real anticipated needs, not hypothetical emergencies. That determines how much should be in accessible versus locked accounts. And what does your income picture look like in retirement from all sources, including Social Security, any rental income, any part-time work? That determines how much sequence risk your portfolio actually faces, which determines your appropriate allocation as you approach retirement. None of these questions have universal answers. None of them fit in a listicle. All of them matter enormously to whether your investing strategy actually serves your life or just serves the average person the strategy was designed for. Here are your specific takeaways. First, set it and forget it is right for contributions and wrong for allocation management. Automate contributions. Review allocation annually. Rebalance when drift exceeds 5 percentage points from your target. Reassess strategy when your life changes. 15 hours a year, non-negotiable. Second, count your actual distinct exposures, not your number of funds. If your funds share top holdings, you're not diversified, you're concentrated with extra paperwork. Build toward genuine diversification across assets that actually behave differently under stress. Third, the expense ratio is not the most important cost in your portfolio. Tax drag, transaction costs from poorly timed switches, and behavioral costs from holding investments you don't understand are all larger for most investors. Minimize fees, yes, but not at the expense of tax efficiency or behavioral resilience. Fourth, if you're in a target date fund, open it and look at what's inside it. Understand the glide path. Decide whether it matches your actual situation rather than the hypothetical average person it was designed for. Fifth, before maximizing 401k contributions beyond the match, ask whether traditional or Roth is right for your tax trajectory and whether you need accessible capital in a taxable account for foreseeable opportunities or life events. The answer for many people under 40 is more Roth, more taxable than the maximize the 401k always doctrine suggests. The 11-year investor I mentioned at the beginning ran all of these diagnostics on his portfolio after a conversation that changed how he thought about investing. He consolidated his 8 overlapping funds into a more intentional allocation. He switched future contributions to Roth once he understood his tax trajectory. He opened a taxable brokerage account and started building accessible investment capital. He adjusted his equity allocation upward from the target date fund's generic glide path because his actual risk capacity and income diversification warranted it. He didn't start over, he refined. And the projection of what his adjustments will mean by 65 is significantly better than the projection he was running on. Not because he suddenly found a secret strategy, because he stopped applying generic advice generically and started applying specific thinking to his specific specific situation. That's the difference. Not complicated, not sexy, just honest.